All right, so today we're diving into, well, I'd say a classic, The Intelligent Investor by Benjamin Graham. And, this book is considered like a foundational text when you think about value
Yeah.
investing, and for good reason.
Yeah, it's amazing how relevant this book still is today.
Yeah.
Even though it was published way back in 1949,
Right.
Graham's insights into market psychology and really the principles of just sound investing, they're
Yeah,
timeless.
exactly. And speaking of Graham, it's important to remember that he wasn't just like an academic,
Right.
writing about investing from like an ivory tower or something like that.
Yeah.
He was actually a Wall Street veteran who experienced the highs, of the roaring 20s,
Mm-hmm.
and then also the devastating crash of 1929.
Yeah.
And his experiences from that really shaped his investment philosophy.
Yeah.
And, that comes through so clearly in this book.
And it's not just any investment philosophy. It's,
Right.
it's had a huge impact on some of the most successful investors of all time.
Yeah.
Warren Buffett, for instance, was a student of Graham's at one point.
Yeah.
And has often said that The Intelligent Investor is by far the most important book on investing that he's ever read.
Okay, so let's jump into the book itself.
Okay.
The introduction really kind of sets the stage
Yeah.
by drawing a very clear distinction between investment and speculation.
Mm-hmm.
And, this is a core idea that kind of runs throughout the entire book.
Yeah, and Graham is very clear about what he means by investment.
Right.
He defines it as an operation which, upon thorough analysis, promises safety of principal and a satisfactory return.
Okay.
So anything that doesn't meet those two criteria, he's basically saying falls into the realm of speculation.
But he doesn't completely demonize speculation, does he?
He doesn't.
He acknowledges that there's a place for it,
Yeah.
especially for those who, enjoy the thrill of taking risks.
Mm-hmm.
But his main point is that speculation should only be done with money that you can afford to lose.
Mm.
And it should never be mistaken for true investing.
Exactly. And he even suggests, allocating a small portion of your capital,
Right.
like no more than 10% for purely speculative purposes.
Okay.
So this way you can satisfy that urge to take risks without jeopardizing your long-term financial well-being.
Yeah. And he shares the story of Sir Isaac Newton,
Oh, yeah.
who, despite being a brilliant scientist, lost a fortune in the South Sea bubble.
Right.
It's a cautionary tale
Big time.
about how even the smartest people can get caught up in that market frenzy
Mm-hmm.
and make irrational decisions.
Yeah, absolutely. And that leads us perfectly into Chapter 1, Investment versus Speculation.
Okay.
And here, Graham really delves deeper into this critical distinction.
Okay.
He talks about the importance of having a sound investment philosophy based on thorough analysis, patience, and discipline.
He introduces the concept of an intelligent investor,
Mm.
someone who approaches investing with a rational, long-term mindset,
Right.
focusing on minimizing risk and achieving those satisfactory returns over time.
Yeah.
It's not about getting rich quick. It's about building wealth steadily and securely.
And for those who are new to investing, Graham has some very practical advice.
Okay.
Avoid trading on margin.
Okay.
Borrowing money to invest inherently increases your risk,
Right.
and that can push you into dangerous territory, that speculation territory.
He uses the example of the speculative frenzy in the late 1960s, particularly around conglomerate companies and letter stock, to show how easily investors can get caught up in hype and kind of disregard that fundamental analysis.
Right.
It's a reminder that market trends can be fleeting,
Yes,
and it's always important to focus on the underlying value of the investments you're considering.
absolutely.
Yeah. So then in Chapter 2, The Investor and Inflation, Graham tackles a concern that's probably on many people's minds, especially in today's economy.
Yeah, for sure.
He acknowledges that inflation is a legitimate concern for investors,
Mm-hmm.
but warns against simplistic strategies like buy stocks to beat inflation. He points out that the relationship between stock prices and inflation is more complex than that,
Yeah.
and it's important to consider factors like bond yields and stock yields, particularly during periods of high inflation.
Yeah, and he doesn't just offer vague warnings either.
Right.
He provides very specific guidance on how to navigate this challenge.
Like what?
Well, for instance, he suggests diversifying into real estate or gold as potential inflation hedges.
Okay.
And I think it's important to note that while those were relevant back then,
Right.
today's investors might consider REITs or those Treasury inflation-protected securities,
Sorry.
yes, as more accessible and practical alternatives.
That's a great point. It's important to remember that while Graham's principles are timeless, the specific investment vehicles may evolve over time.
For sure.
And I think that's one of the key takeaways from Chapter 3, A Century of Stock Market History.
Yeah.
This chapter delves into historical market trends and emphasizes the inherent volatility of the stock market.
Yeah, he's not trying to scare people away from investing, though.
Right.
He's actually trying to prepare them for the ups and downs.
The inevitable ups and downs of the market.
He really wants readers to understand that focusing on those long-term trends is crucial,
Right.
rather than getting caught up in the short-term fluctuations.
And he cautions against trying to predict the future of the market based solely on past performance.
Yeah.
Right? Just because the market has gone up for the past few years, it doesn't mean it will continue to do so indefinitely.
Exactly like those wildly optimistic predictions in the 1990s.
Dow 36,000.
Yes, those forecasts were based purely on extrapolating past returns.
Right.
And proved to be way off.
Yeah, as Graham would say, the market is unpredictable in the short term,
Yeah.
but over the long term,
Yeah,
it tends to reflect the underlying value of the businesses.
exactly. And that leads us into Chapter 4, General Portfolio Policy, the defensive investor. And this is where Graham starts getting into the practical aspects of building a portfolio, specifically for those who consider themselves passive or defensive investors.
All right, so we'll pick up with Chapter 4 in the next part.
This is where Graham lays out his famous rule of thumb when it comes to asset allocation,
Okay.
that 50-50 split between stocks and bonds.
Okay.
He argues that this simple approach provides a really good balance between growth potential and that capital preservation,
Wow.
which is ideal for the defensive investor.
And he's very specific about the types of bonds he recommends.
He is.
All right.
He leans towards those high-grade corporate bonds,
Okay.
or even U.S. savings bonds,
Okay.
prioritizing safety and stability over potentially higher returns from riskier investments.
It's interesting to see how Graham's thinking evolved over time on this.
It is.
In earlier editions of the book, he advocated for a minimum of 25% in stocks and a maximum of 75%.
Yeah.
But in later editions, he settled on this 50-50 split, suggesting that this balance is suitable for most defensive investors.
Yeah.
Now in Chapter 5, The Defensive Investor and Common Stocks, Graham dives into stock selection for the passive investor.
Okay.
He provides some clear criteria,
Yeah.
recommending large, prominent, and conservatively financed companies.
Mm.
Think well-established businesses like Coca-Cola or Johnson & Johnson.
Right. He steers clear of those smaller, less established companies or those with high debt levels.
Right.
The emphasis is on minimizing risk and sticking with those proven businesses that have that long track record of stability and profitability.
Then in Chapter 6, Portfolio Policy for the Enterprising Investor.
Yeah.
Negative approach. Graham shifts gears and starts talking about what enterprising investors, those who are willing to take on more risk,
Right.
what they should avoid.
Yeah, he calls this the negative approach
Right.
because he's focusing on the common mistakes
Right.
that aggressive investors often make.
So he warns against buying into popular or hyped up stocks,
Right.
chasing after those quick profits
Yeah.
and trying to time the market.
It's a chapter full of cautionary advice.
Yeah.
He cautions against overpaying for growth, falling for market fads, and neglecting proper diversification.
It's almost like he's anticipating some of the pitfalls that investors face even today.
Absolutely. And he even advises against putting too much faith in those professional investors,
really?
arguing that they can fall prey to the same errors as individual investors.
So it's a reminder that ultimately you are responsible
You are.
for your own financial decisions.
For sure.
So after all that caution,
Okay.
Graham finally gets to the positive side.
Okay.
In Chapter 7, Portfolio Policy for the Enterprising Investor, the positive side.
All right.
This is where he outlines strategies that those aggressive investors can use to potentially outperform the market.
Okay.
He offers several approaches, each with their own set of risks and rewards. He discusses investing in undervalued or those bargain stocks, looking for companies with strong financial positions and low debt levels, and seeking out those special situations, like mergers and acquisitions.
Right.
This is where his deep knowledge of security analysis really shines through.
Yeah.
And even with these strategies, which are inherently more aggressive,
Yeah.
he stresses the importance of maintaining that margin of safety. He constantly reminds readers to never overpay for an investment, no matter how promising it might seem.
Right.
Chapter 8, The Investor and Market Fluctuations, is a classic.
Yeah.
This is where Graham introduces the concept of Mr. Market,
Mm.
which is this brilliant metaphor for the unpredictable and often irrational nature of the stock market.
So Mr. Market is this manic depressive character
Right.
who shows up at your door every single day,
Every day.
offering to buy or sell you stocks.
Okay.
Sometimes his prices are reasonable,
Yeah.
but often they're driven by fear or greed,
Right.
completely detached from the actual value of the businesses he's quoting.
So Graham's point is that you shouldn't let Mr. Market's moods dictate your investment decisions.
Exactly.
The intelligent investor, according to Graham, they take advantage of Mr. Market's irrationality,
Yes.
buying when he's pessimistic and selling when he's overly optimistic.
But never letting Mr. Market's swings control their emotions.
Yeah. It's such a powerful way to think about the market.
It is.
This chapter is really about developing that psychological discipline
Mhm.
to stay focused on your long-term goals and not get swept up
Right.
in the market's day-to-day drama.
Exactly.
Now, in chapters 9 and 10, investing in investment funds and the investor and his advisors, respectively,
Mhm.
Graham shifts his focus to the world of professional money management.
Okay.
He acknowledges that many investors, particularly those with limited time or expertise, may choose to invest through mutual funds or seek advice from those financial professionals.
Right. And he offers some valuable guidance on how to select those funds and advisors.
Okay.
He emphasizes the importance of low fees, long-term track records, and a philosophy that aligns with your own investment goals.
And just like with individual stocks, he cautions against chasing after funds with the hottest recent performance.
Right.
He emphasizes that past performance is not always a reliable indicator of future results.
Exactly.
And it's more important to understand the fund's strategy
Mm-hmm.
and how it aligns with your overall investment plan.
Yeah. Chapter 11, Security Analysis for the Lay Investor. General approach is where Graham delves into the nitty-gritty of evaluating a company's financial statements.
Okay.
He walks readers through key concepts like earnings per share, book value, and the debt-to-equity ratio.
So he's providing the tools
He is.
to assess a company's profitability,
Mhm.
financial health, and valuation.
This chapter can be a bit technical,
Yeah.
but it's essential for understanding how to determine whether a stock is truly undervalued or overpriced.
So he's demystifying financial statements and empowering investors to make those informed decisions.
Exactly.
Then, in Chapter 12, things to consider about per-share earnings, Graham goes even deeper
Yeah.
into the complexities of earnings analysis.
Right. He cautions against blindly accepting reported earnings,
Okay.
arguing that they can be manipulated or distorted by those accounting gimmicks.
It's a reminder that numbers can be misleading,
Yeah.
and it's crucial to understand what's behind them.
Exactly. He emphasizes the importance of looking beyond those headline numbers
Right.
and understanding the underlying drivers
Yeah.
of a company's profitability.
He wants investors to develop a critical eye and not just take things at face value.
Right.
Now, Chapter 13, Stock Selection for the Defensive Investor, brings together many of the concepts we discussed earlier in the book,
Mm-hmm.
specifically for those passive investors
Right.
we talked about.
He provides specific criteria
Okay.
for selecting stocks that meet the needs of this type of investor,
Mm-hmm.
reiterating the importance of investing in those large, stable companies with a history of paying dividends.
He introduces the concept of a portfolio of minimum effort,
Mm-hmm.
suggesting a diversified selection of blue-chip stocks that require minimal monitoring. It's a very hands-off approach designed for those who want to invest for the long term without constant tinkering.
Yeah, and even with those blue chip stocks, he warns against overpaying,
Right.
emphasizing the need for a margin of safety, even with high-quality companies.
That concept of margin of safety is so central to his philosophy.
Absolutely. And then we get to Chapter 14, Stock Selection for the Enterprising Investor.
Okay.
And here, Graham offers more advanced techniques
Yeah.
for identifying potentially undervalued stocks.
Okay.
This is for investors who are willing to put in more time and effort to research and analyze companies.
So he discusses strategies like looking for companies with low price to earnings ratios, high dividend yields, and strong asset values.
Mm-hmm.
These are those classic value investing metrics designed to uncover those hidden gems in the market. He even introduces the concept of net-net investing,
Mm-hmm.
which focuses on companies whose liquidation value,
Right.
if you sold off all their assets,
Yeah.
actually exceeds their market capitalization.
It's a deep value approach that requires a lot of research,
Right.
but can potentially yield some significant returns.
And then we have Chapter 15, Convertible Issues and Warrants.
Okay.
This is where Graham kind of takes a slight detour
Mm-hmm.
and delves into these more complex securities.
Yeah.
He acknowledges that they could be tempting, especially during like bull markets.
All right.
But he also warns against their inherent risks.
Mm-hmm.
He argues that convertibles and warrants are often overpriced
Yeah.
and can lead to significant losses if the underlying stock declines.
Right.
His advice:
Yeah.
most investors, particularly those with a defensive mindset, are better off avoiding these types of securities altogether.
Yeah, I agree with that.
Now, in Chapter 16, 4 extremely instructive case histories, Graham shifts gears again.
Okay.
He uses real-world examples
Mm-hmm.
to illustrate the principles that he's been talking about
Yeah.
throughout the book.
So he examines 4 companies,
Right.
each representing a different type of investment situation. So there's a company with a rock-solid operating history,
Okay.
another one with earnings that are all over the map,
Okay.
one that's in the midst of a financial turnaround,
Okay.
and finally one that fell victim to market manipulation.
It's a fascinating look at how Graham applied his analytical techniques
Yeah.
to these real companies.
These case studies are like mini deep dives themselves.
Yeah.
They show how to assess a company's financial health,
Right.
evaluate its management, and identify those red flags.
Yeah. They bring Graham's principles to life
They do.
and demonstrate the importance of thorough research and analysis.
And then we get to Chapter 17, the margin of safety as the central concept of investment.
Okay.
This is arguably the most important chapter in the whole book.
Yeah.
It's where Graham hammers home the idea that the margin of safety is essential for minimizing risk and achieving long-term success in investing.
He argues that no investor can be right all the time.
Right.
So the margin of safety is like a buffer against errors in judgment,
Yeah.
unexpected events, and the inherent uncertainties of the market.
It's not just about buying those cheap stocks.
Right.
It's about demanding a sufficient discount to the intrinsic value of a business to compensate for the unknowns.
And in Chapter 18, Summary of Sound Investment Policy, Graham shifts from those specific strategies
Yeah.
to the broader mindset needed
Mm-hmm.
for successful investing.
He emphasizes the importance of patience, discipline, and emotional detachment.
Right. He reminds readers that the investor's chief enemy is often themselves.
Mm-hmm.
It's their own emotions.
Yeah.
Fear and greed can lead to those impulsive decisions that undermine long-term goals.
And Graham advocates for a rational approach based on thorough analysis and that long-term perspective.
And finally, in the postscript, Graham offers some reflections on the market environment.
Of the early 1970s.
Right. Even back then, he was concerned about the growing focus on short-term performance
Mm-hmm.
and the tendency to chase after those latest hot stocks.
He sounds a lot like someone commenting on today's market, doesn't he?
He does. It's amazing how his warnings about market fads and the dangers of speculation
Right.
are just as relevant today
Mm-hmm.
as they were decades ago.
He reminds us that regardless of those market trends, sticking to sound investment principles is crucial.
So what does all this mean for you?
Well, if you're serious about building long-term wealth through investing, The Intelligent Investor is an invaluable resource.
Right. It's a guide to navigating the complexities of the market with wisdom, discipline, and a focus on minimizing risk.
Graham's principles are timeless, and while that specific investment landscape may change his core ideas about value investing, margin of safety and emotional discipline are as relevant today as they ever were.
Now, we want to leave you with a final thought to ponder.
Okay.
How would Graham's principles apply to today's market environment?
Mm-hmm.
With the rise of cryptocurrencies, the ease of investing through apps, and the influence of social media, would he stick to his classic approach
Right.
or adapt to these new developments?
That's a fascinating question to consider as you delve into this timeless classic.
So dive into The Intelligent Investor, explore its wisdom, and most importantly, apply its lessons to your own financial journey. Remember, knowledge is power, but only when it's put into action.